Joining us now, former Kansas City Federal Reserve President and Distinguished Fellow at the Mercatus Center at George Mason University, Thomas Hoenig. Mr. Hoenig, good to have you. I'm curious, do you think we'll get any hints from the Fed or from Chair Powell at the press conference about the next potential hike?
I seriously doubt that he will give any. I think he will try and avoid giving any hints because I don't think the Fed knows quite yet what they want to do in September. They're looking at major forces that they have to still figure through. Number one, we're still experiencing, the U.S. is still experiencing the effects of enormous fiscal stimulus over the last 3 years, including not starting just with the CARES Act, but more recently the infrastructure bill, the CHIPS bill. These are all increasing spending. We're seeing it in wages and wage pressures now. So they have that side of it that they're dealing with. That would suggest a rate hike. But on the other hand, they have raised rates by a factor of more than 25 now, if they move ahead today, as everyone expects they will. That has slowed the economy, especially the interest-sensitive sector. It's affected commercial real estate, other areas. And so they're balancing that. And I don't think they know quite yet how that's going to play out over the next couple of months. So they're going to wait and see. And I think the chairman would be very careful in his conference today, we'll see, not to hint one way or the other very much, but to say we're data dependent, we're going to wait and see.
Yeah, you mentioned that fiscal stimulus we've gotten out of Congress, of course. The IRA is another one, so infrastructure, IRA, chips, that's a lot of money. But how does the Fed measure that, and are they capable of sort of measuring it in real time in terms of what the longer-term impact will be?
Well, they are capable of measuring it. Whether they can measure it as precisely as you would like so they can say what they're going to do in September, no, that's doubtful, because how is labor going to go forward with this, and how much more pressure are we going to see? Real interest rates right now are positive. If inflation continues to come down, that means that real interest rates will be even stronger, so that may pull some other pull the economy down some more and slow the inflation. So they are measuring it constantly, but they don't know yet how it's going to shape out by September. They think they may, but they don't know for sure, and they're going to wait and see, I suspect.
Thomas, tomorrow we're expecting what's known as Basel III endgame. David and I were talking about it earlier in the hour. And, given your experience, I think 3 decades between the Fed and the FDIC, which are 2 of the 3 agencies tasked with creating these rules, what are your expectations on that front? And what do you think the overall impact will be?
Well, as I understand it, and I haven't seen it yet, but all the discussions are that it's going to affect the trading account. We're talking about for the largest banks, the 2%, that's from Michael Barr's outlook, 2% increase in capital. That's going to affect the largest banks only. They usually can manage through that pretty carefully and do so. And I don't, even though they're going to say it's going to stop lending, I doubt very seriously that will have anywhere near the effect that higher interest rates will have on lending. So I think it will be a modest effect on the economy and on the institutions, and in the event, since they're looking at market risk and operational risk, the fact that they're looking at this is probably a good thing, and I would suspect it will actually promote financial stability in the longer term, which is a goal they have, and will be separate from the effects that monetary policy is going to have over the next 6 months or so.
Interesting. So you think that it won't have as much of an effect as higher interest rates will on lending. But those 2 combined, is that a concern of yours, given just the overall impact of higher interest rates plus higher capital rules on just the overall credit availability in the system at the same time?
Well, the credit availability issue is obviously complicated. Number one, yeah, the higher interest rates are affecting credit, no question about it. But also the uncertainty around the level of interest rates are causing banks to be more careful. Their loans are under pressure because of the higher interest rates. Those asset values are taking downward pressure. They already have it in their bond portfolio. So that's going to continue to cause banks to pull back. I think the additional marginal increase in capital probably should have come 2 years ago, but the fact that it's coming now, I think will also add to the slowdown, but nowhere near as substantially as the interest rate increases. Even today's rate increase will slow it down more than I think the capital increases will. if they stay there at these higher rates very long. So that's where I would focus my interest and attention, because the economy is still on fiscal stimulus. They're still trying to slow it. That's where they're going to focus. And the capital ratios will come in as a factor, but less so than the interest rate environment.
Thomas Honig, appreciate your time. Thank you.
Sure. Glad to be with you. Thank you.